To understand what happened to silver in the first 4 days of December 2025, you have to understand the ghost market that COMEX and the banks never explain. Most people think registered silver sits in vaults, ready for delivery. They're wrong. Over 47.6 million ounces were claimed in just 4 trading days. That's 60% of all registered silver at COMEX. But here's what CME Group isn't telling you. Those ounces didn't exist where the market thought they did. The mechanism works like this. A refinery holds physical silver. They short futures contracts to hedge. When price moves violently, they owe cash instantly. But refineries don't hold cash at 2 a.m. They hold molten metal. Where do they get $50 million overnight? They don't. This is why production freezes. This is why Samsung's battery breakthrough just became a supply crisis. December 14th, 2025. Silver is trading at $62.30 per ounce. The metal hit $63.48 on December 11th, its highest level in history, surging over 119% this year. But try to buy physical silver at that price. Go ahead. Call the wholesalers in North America. Check with Swiss refineries. You're going to hear unavailable, or you're going to hear nothing at all. COMEX vault inventories have declined by over 73% since 2020, exposing systemic vulnerabilities nobody wanted to acknowledge. Shanghai silver vaults logged their largest weekly outflow ever, down 257 tons, dragging inventories to 663 tons, the lowest in 21 months. That's 43% of all stored silver vanishing in 2 weeks. If you woke up this week and felt that pit in your stomach watching deliveries skyrocket while physical premiums exploded, you're not alone. The paper market just admitted it doesn't have the metal it promised. In this investigation, I'm going to show you how Samsung's solid-state battery technology, why requiring 1 kilogram of silver per vehicle, collided with the worst supply crisis in modern history, why COMEX's 60% vault drain in 4 days signals a systemic break, and what happens next when industrial demand meets empty vaults. Let me walk you through exactly how this market broke. Normally, silver trades in 2 worlds. Paper silver on COMEX, where traders bet on price using futures contracts. Physical silver in vaults, where actual metal sits. These 2 worlds used to stay connected because most futures contracts settled in cash, not metal. But what happens when industrial buyers need actual silver, not paper promises? First, Samsung announced its solid-state battery breakthrough. The battery boasts a range of up to 600 miles on a single charge, can recharge to 80% in just 9 minutes, and is designed to last for 20 years. The innovation uses a silver-carbon composite layer for the anode. Estimates suggest each battery cell may require up to 5 grams of silver, and a typical 100 kilowatt battery pack could use about 1 kilogram of silver per vehicle. Do the math. If 20% of global car production, about 16 million vehicles, used these batteries, annual silver demand for EVs alone could reach 16,000 metric tons. Global silver production, around 25,000 metric tons annually. One technology is consuming 62% of global production. Second, the supply side was already broken. The silver market is forecast to record another significant deficit for the 5th consecutive year in 2025. We're talking structural deficits, not temporary shortages. The cumulative deficit since 2021 has approached 800 million ounces, equivalent to an entire year of global mine production. Third, around 70% of silver comes as a byproduct of mining other metals like copper and lead. You can't just mine more silver when prices rise. Base metal producers prioritize their main products. Supply is inelastic. Fourth, industrial buyers panicked. Solar manufacturers, electronics companies, and now EV battery makers realize they're competing for metal that increasingly doesn't exist at the paper price. So they did what Bank of America and JP Morgan couldn't predict. They stood for delivery. 7,330 silver futures contracts requested physical settlement in a single day, about 30% of COMEX free float. That's over 36 million ounces demanded immediately. The exchange had the contracts. They didn't have the metal. Fifth, refineries got squeezed. They hedge by shorting COMEX futures while holding physical inventory. When silver spiked from $30 to over $63 in less than a year, their short positions bled millions daily. CME demanded margin. Cash. Now. But refineries don't have $50 million in cash sitting around. They have silver in furnaces. They have ore in processing. To cover margin calls, they'd need to sell physical, ship it, and wait for settlement. By then, they're in default. So refineries stopped buying raw ore, production froze, and suddenly the 60% vault drain at COMEX wasn't a statistic. It was industrial buyers stripping every available ounce before the system admitted it was a ghost market. This is the liquidity nightmare. Paper silver promised delivery. Physical silver wasn't there. And now Samsung needs 16,000 metric tons per year for batteries that revolutionize EVs. I want to take you back to January 1980. Nelson Bunker Hunt and William Herbert Hunt decided to corner the silver market. They accumulated physical silver aggressively using debt and futures contracts. By January 17, 1980, silver hit $49.45 per ounce. COMEX panicked. They couldn't deliver on all the contracts, so they changed the rules. Silver Rule 7, implemented overnight. It banned new purchases on margin and allowed liquidation-only trading. The Hunt brothers couldn't roll their positions, couldn't buy more. Within 3 months, silver crashed from $49 to under $11. The Hunts lost billions. COMEX survived. But here's what's different in December 2025. In 1980, it was 2 guys. Speculators. They borrowed money to manipulate the price. When COMEX changed the rules and triggered margin calls, the Hunts had to sell. The market corrected because the demand was artificial. Today, the demand is structural. Samsung isn't speculating. Samsung SDI's pilot solid-state EV battery production line is now fully operational, with samples delivered to customers receiving positive feedback. Toyota signed an agreement for mass production starting in 2027. This is industrial demand backed by the global transition to electric vehicles. Solar manufacturers aren't gambling. Industrial demand is reaching over 700 million ounces, driven by photovoltaics, electronics, and EVs. These buyers need silver for production, not profit. Central banks aren't speculators. They're accumulating physical assets as a monetary hedge. Silver-backed exchange-traded products saw substantial inflows, with total holdings increasing by approximately 130 million ounces this year. Apply the pattern from 1980 to today. Stage 1. Aggressive accumulation drives prices higher. Check. Silver is up over 119% in 2025. Stage 2. COMEX inventories drain rapidly. Check. Over 60% of registered silver was claimed in 4 trading days. Stage 3. Exchange implements emergency measures. Happening now. Backwardations reached up to $3,000 per contract, signaling severe disconnect between paper and physical. Stage 4. Rule change forces liquidation and crashes the price. Failed. Here's why the kill switch didn't work this time. In 1980, COMEX could force the Hunt brothers to sell because they were leveraged speculators. Margin calls bankrupted them. Today, who do you margin call? Samsung, Toyota, solar manufacturers with locked supply agreements. The lesson from 1980 is clear. When COMEX faces a delivery crisis, they change the rules. But rules only work when demand is speculative. When demand is industrial, permanent, and structural, changing rules doesn't create metal that doesn't exist. The banks fired their weapon. It turned out to be a firecracker. So what happens next? Based on COMEX vault data and industrial demand projections, here's what's coming. Stage 1. The physical premium explosion, $62 to $75. Timeline, next 30 days. Driver, physical premiums on bullion coins and bars have already soared as retail and industrial demand outstrips supply. As Samsung ramps production and solar manufacturers lock annual contracts, the gap between paper price and physical availability widens. Expect $10–13 premiums on physical over spot. Stage 2. The industrial panic, $75 to $95. Timeline, Q1 2026. Driver, When Toyota and Samsung begin mass production with silver carbon batteries, competing manufacturers will panic buy to secure supply chains. Each 100 kWh battery pack requires 1 kilogram of silver. If 16 million EVs adopt this technology, that's 16,000 metric tons of new annual demand hitting a market already in its 5th consecutive year of deficit. Buyers will pay whatever it takes. As of December 14, 2025, we're watching Stage 1 unfold in real time. COMEX registered silver down over 60% in 4 days. Shanghai vaults collapsed, losing 257 tons in a week. The paper market is admitting it can't deliver. Friday, December 13, 2025. The margin nuke failed. The vault drain exposed the ghost market. Samsung's battery technology just weaponized industrial demand. If you're holding physical silver, you made the right call. You own the metal that Samsung needs, and COMEX can't deliver. Do not let paper price volatility shake you. The game has changed. This isn't speculation. This is structural scarcity meeting technological revolution. Physical holders, you're holding the choke point in the greatest supply crisis of the decade. Industrial buyers will come to you, not COMEX. Stay stacked. Stay strong. I'll see you at $95. Subscribe.